This is Tom Aspray with the Viper Report market wrap video for the week ending July 11th. A mixed close on Wall Street after Thursday's sharp gains. Some cautionary or profit taking hit the market on Friday. I just posted a new article to Forbes.com. Will more crazy tariffs stop the most hated market rally? I'm starting to wonder the tariffs on Brazil, because he doesn't like the justice system, is stranger than we've seen in a while. So one wonders whether this is just to take the attention away from some of the other issues like FEMA and Epstein that keep bugging him. In any case, in the article, you can see, search for my stuff on Forbes.com, you'll see kind of when I look at the market. This is the scoreboard. The Dow was down 1%, NASDAQ down 0.4, New York Composite 0.9, S&P 0.3, transports, utilities were higher, and gold was higher. Small caps took a breather. On a year-to-date basis here, not really spectacular at this point, but as I point out in the article, if you look at some of the numbers like these put out by the Carson Group and Mr. Dietrich, after 3 months like we've had, the average return 6 months out is like 17%. So that would make for a banner year. Let's look at some of the charts here. First, the weekly charts of the S&P 500. You can see it's formed a doji here. This is the cash, and so that means that a close next Friday below 6201 will trigger a weekly doji sell signal. So what does that mean? Typically that means just a minor correction. I think in the article I've said 2 to 4%. So if I'm not looking based on the AD lines for a stronger correction, as that would take more time for a top to develop, as it did here in late 2024 and early 2025. The weekly AD line has turned down slightly, but still clearly positive. Broke out of a trading range, so no problems there. Based on the relative performance, of course, the QQQ has been our favorite. You can see it also has formed a doji last week. The old highs 541. That's the important support. So that's like 13 points below where we are here. Clear positive trend in the NASDAQ 100 AD line on a weekly basis. Plus, I always in my teachings, look, once you see a moving average 20 EMA, this is weekly, that's moving that sharply, that's a real sign that a major top is not likely for a number of weeks. It takes time for those stronger numbers to drop off. A big week for data. Of course, we get the CPI on Tuesday and the PPI on Wednesday, plus some market sentiment, housing data, etc. This is a chart of the 10-year note yield. Looks like it's ready to turn higher. Had a pretty well-defined decline, closing above its pivot at that point. This is a yield, remember, so that's 4.326. So the upper Stark band is at 4.506. And if we look at this on a weekly basis, it's not quite as clear. Pretty much histogram is negative, as are the lines, so it could go either way there. But certainly on a short-term basis this week, obviously if the CPI is stronger, most of people are looking for 2.6, is greater than expected, likely to push yields higher, as it will likely make the Fed less likely to cut rates in September. The current percentage on that in the futures market is 60% think they will. If we look at some of the other interest rate, futures, this is the 2-year note, of course a little more sensitive. You can see that it's, pretty neutral here. So, it gets above, 4% here, would be right about in there. That's going to turn the short-term bias to the upside. Major downtrend, and the Stark bands are up in the 4.37 to 4.568. If the market corrects before Thursday, we could see a further pullback in the bullish percentage. You see this is a major bottom here we formed in March and May. You can read the articles in Forbes. It was a rare occurrence when it got this low. For example, it got to minus 40 something, minus 56 in March of 2009 at the bear market low. But then prior to that, there weren't a lot of lower readings. So pretty significant. I don't think I expect the bullish percentage, to continue to rise until it gets in the mid 40s or so. You can see it spends a lot of time there. Stark bands here did a great job of. Also, you look at the Stark bands here; they're below the lower bands, so it's the envelope was stretched on the downside, along with low bullish sentiment. That's a good buying opportunity. And the daily and 80 lines don't show signs of a significant correction. Before that happens, we'd expect to see them drop below their moving averages, and the moving averages would start to roll over their 21-day moving averages. So once again, it'd take a while for them to do that. So the AD line broke out. It's formed slightly higher highs. Stocks only is acting well, as is the NYSE AD line, also acting well on a short-term basis. A little less positives in the Qs, though the weekly are still looking strong. You can see the daily AD line has formed a short-term divergence, so that means we could see a pullback there. And you can see the pivot and the major support are right around 540, and still outperforming the S&P. So don't think that's going to change, as the weekly numbers look pretty good in terms of relative performance. High-low analysis still positive. We had a spike in the new highs up almost to 200. Still well below levels we saw in the latter part of 2024. But so far, no increase in the new lows. We'll be looking for that for signs of heavier selling if it develops. NASDAQ Composite, see the same thing. We had a little divergence here. The new highs peaked at over 200, over 300 rather, and now made lower highs. So that is also consistent, with a short-term pullback. The growth value ratio is still rising. Turned up slightly last week. MACDs are in the positive mode, so suggests that this is, are we going to fail up at these highs? Anything is possible, but everything I look at still favors growth over value. But I would think before the end of the year, there'll be a good opportunity to start loading up on some value plays. If you look at the weekly chart of the Qs, it still looks strong, higher highs on the weekly AD line. It's been a great trend, since late 2022, early 23. We moved above the yearly pivot here, held above it all year. Yearly pivot was here for 24, held above it, broke below it early in 25, got down to the S1. Now our next target we're looking for is 572. So we may see a pullback before we get a move up to that level. I'll be doing a slightly shorter video this weekend. I have torn my meniscus in a knee, and it's not getting any better. In fact, it's getting worse. So sitting and recording is not as easy as it used to be. I wanted to take you back on the time machine, though. So this is the ETF report. You can see up here, April 4th. Just show you how things have changed. So at that point, only 9.2% were above their quarterly pivots. You can see here in the growth thing, nothing. We got new, weekly and quarterly negative signals for healthcare. Down below here, XLE and VDE. That's the Vanguard Energy. Also, needless to say, the short ETFs were all green, 100%, 100%, 100%. And of course, the leveraged long were all red. That's what you would have expected. So, that's where we started, and then as the AD lines started to kick in gear, as I mentioned in the article, the latter part of April. Then we used the, Jerry's wonderful watch list to help target ETFs and stocks. So let's look at current ETF report. You can see that 89.3%, 80% more than that last one I showed you. And, pretty much it's the opposite extreme. Most things are green, so in the growth thing, we have, missing DTS red on cloud, IPO, and still in XLV, but 90% of them are positive. And, and 70% are DTS. You can see here, values also looking firm. XLC turned, and we'll talk about that in a second. But the rest of them, usually I don't reverse out of a position based solely on a negative DTS. Usually it has to flip to a 3-day, and conversely, when I'm looking to buy, I look for a daily turning into a 3-day. So value strong, short ETFs still red, so no signs that they've bottomed. Had an increase in volume here in the small cap triple inverse, as we did in the SDS. It's an S&P product. So down here, long ETFs still 100%. We're still in TQQ, and but we haven't made it to our targets yet, so we're getting a little more defensive there. So on to the sector report. A couple of these two, in fact, sectors seem like they've really bottomed in terms of, you remember this light green is the fast moving average and the blue is the slower moving. So we just turned back up, in the fast to move back above the slow in energy. Not a lot of red here. You can see that PSX and MPC are 1 hourly, but that's about it. So don't look like a lot of great setups right in here. Materials, also has turned a corner, it appears. Here it looks a little more interesting. So we position in home builders. You have Sherwin-Williams, you have EGL, you have PPG, and CTVA, are going from 4 hour to daily. So what you're looking for is, since the weekly and the 3-day are positive on those, look for a daily flash to say, okay, the pullback there is over. Industrials also, they had a kind of a correction here. We stuck with it, and there's some stocks we'll be watching if we do get a pullback early in the week. Some of the conglomerates, Honeywell, etc. ATN is still all green. ADP is all red. So, and Deere is sort of a mixed bag. So it's got a negative 3-day. The rest is positive. Consumer discretionary been a little bit disappointing, mainly because of Tesla's, of course, getting hit pretty good. And you can see the chart here, is still in a downtrend. So, the individual ETF does not look as bad. Not a lot of things here to look at. TGX and, Nike have 4 hour, but we'll be looking for a shift there. Consumer staples, lots of red. Of course, it's more defensive, so if the market does correct, I'd expect to see an uptake in that group. Healthcare, that's probably, you can see by this chart, it's going to have its time, maybe not, probably by the end of the year, but I think I said that last year too. So you got to wait till the technicals get in gear. Financials are surprisingly weak, of course, with bank earnings this week. Technically, particularly the regional banks have had some dramatic moves, so they could use a correction to get into a low risk buy. Technology still strong, a bunch, CRM, Adobe, and Intuit, along with ACN, are all red across the board. So this is one of the situations, these are some of the laggards, you can watch, and as it starts to flash back to green, that'll be a sign that, the pullback is over. XLC also shows a lot of red. Okay, we have Verizon, AT&T, and T-Mobile, so all the telephone stocks are getting hit pretty good. Some of the Charter Communication, Netflix is still positive. So I'd be focused on the ones that have a positive weekly and daily. And utilities, closed up. They didn't do too bad for the week, and also a defensive play. Well, that's pretty much all I have today. Send me your questions and comments, particularly since it was such a shorter report. If you have specific questions and you're a subscriber, shoot me an email. I am reading those more regularly. And once again, the RIPE report, talks about the new highs for the S&P AD line, also some details about the advanced decline line course. I filled in a few for the fall, but we still have some space available if you're interested. And hope you have a great week in trading. I'll be tweeting probably ahead of the CPI report, tell you what the futures look like. They've had a pretty good run, so I usually look at what they're telling me. They broke out of a triangle formation, last week, which is a good sign. It's a little clearer here, so but fell back into it. So you can see the pivot at 62.91 for the futures. So you'd want to stay above that at this point. Currently, the 260 was positive, got stopped out, so it's flat. Thank you very much for tuning in.